Welcome back, traders. Coach Carver here, and in today's video I'm going to be going over a topic that I get asked about a lot, and that is the difference between institutional and retail trading. In this video we're going to go over the various differences between the two, show you some of the reasons why you're probably getting stopped out now, and going over things like support and resistance, why it doesn't really work, break and retest, breakout trading, why people are getting stopped out there. And then we're going to jump into more of the institutional concepts, smart money trading, talking about order blocks, institutional candles, imbalances, right? Just showing you guys a lot of the ways that you can really take advantage of these markets, give you a better understanding of why people are starting to transition into the institutional trading aspects. I'll be dropping a lot more content like this here in the future. If you guys want access to my free Telegram chat where I drop trade ideas throughout the week, some education, some resources, feel free to check that out. It'll be below in the pinned comments. Guys, please do me a favor, smash that like button, hit that subscribe. It helps out the channel, motivates me to go ahead and make more videos like this. So if you guys are enjoying the content, please go ahead, support the channel. Let me know in the comments some of the things that you're getting from these videos, the value you're getting, some stuff you're learning. If you guys have any other videos you'd like me to make something on, let me know. I'd be happy to help. But with that being said, let's jump into the video. All right, ladies and gentlemen, here we are on TradingView. I have GBP JPY, which is a Great British Pound, and the Japanese yen pulled up on the 4-hour time frame, which means each and every one of these candlesticks represents 4 hours of price action. So now we're going to go ahead, we're going to break down the difference between retail traders and institutional traders. And first, I'm going to go ahead and start off with retail traders because, as it sits right now, approximately 90% of the entire Forex market is comprised of retail traders. So traditionally, when you're starting off with retail trading, you're taught support and resistance, right? So let me go ahead, we'll mark this up. Most people would come in here and they would identify like, okay, this is a nice little support level. Some might even go as far as saying, hey, look, I'm cool, I know how to draw zones, so like this is like my support zone, right? And what's happening is every single time price is coming down here, what they're doing is they're buying, and what that's doing as a institutional standpoint is it's creating liquidity. We'll talk about that in a lot of further modules, but essentially, what most people are taught is, to go ahead, you buy at support and you sell at resistance, and then what you do is you set a 15-20 pip stop loss, and then you're good to go. Right? So here we have a nice clean example of some consolidation, or some people would say price is ranging, right? Just kind of bouncing along like a bouncy ball, bouncing between support and resistance. So most people, when price is coming up here, they're selling, and what's happening is they're putting their stop losses up in here. People are buying up here, their stop losses are down in here just below the previous lows, and what's happening is price coming down here and people are buying and selling. Now there's typically two main ways that retail traders will trade, and it's either break and retest or breakout trading, right? So as we continue on through here, we see price finally breaks out, right? So what happened is retail traders are taught when price closes above, or if in another scenario where it was going down and it would be a bearish, it would be looking for the candle to close below your support. Right, so what they're taught is breakout trading. So let's say we were to go through here and do an example of a breakout trade. I'm going to show you why this doesn't work. Right, let's just say you're trying to even target the previous high, or maybe you're even trying to close out this imbalance that we have here. I'll break that down here in a little bit. Typically it would look something like this. Right, they'd be like, okay, put it down here at the support. Some people may even go a little bit lower. That's a 73 pip stop loss. That's kind of intense, but people do it, right? So some people would even put it below the lows. They would do that breakout trade, and then you'd come through here and you'd see that it doesn't play out. Now another variation is break and retest. Right, so price broke out, it closed, now it's retesting. So what's happening is, if you take a look here, we could extend our resistance, which would then turn to support. You could say, look, price went ahead, it closed up, it opened, and then it came down and it retested that. Now at that point you have a bunch of retail traders that are like, look, we got a clean break and retest entry, this thing's about to go to the moon, right? And because that's just what they're taught, breakout, break and retest. And as this is playing out, they're purchasing more orders, more and more orders. But what you guys need to understand is, from an institutional smart money concept, is in that standpoint, the banks, the institutions, smart money traders traders, they know that 90% of the population are taught to trade this way. Support, resistance, put your stop loss 15, 20 pips or just below, the previous low or above the previous high, and go ahead and go for it and just send it, right? And they understand that. So what happens is here we go. We have a breakout, right? Let me show you why this doesn't work. Boom. So what happens is the banks essentially just push price up. It went ahead, it grabbed all of these stop losses from all these sellers, and it's what we call liquidity. We'll make a whole video on this later on. So here we go. The banks just grabbed the liquidity. They stopped out the sellers. Now what are we looking for the banks to do? We're looking for the banks to stop out the buyers. So as you push down, you see boom, stop loss hit. Even if you did that super aggressive 72.4 pip stop loss, guess what? You just got KO'd. So, you'll see a lot of examples like this. So here you have it. The buyers are coming up. The sellers realize, oh, all right, selling didn't work. It's come back down, retest. So obviously I got to buy, right? So then they put a bunch of buy positions in here. Now it not only stops out these buyers, but it stops out the buyers from here as well. So it comes down, does this little manipulation. Smart money traders made money. Now what's crazy is also retail traders are taught the more times that a support and resistance is touched, the stronger it is, right? So somebody would even come over here, draw this line, be like, okay, it was used as a major support, major resistance, this thing's gonna tank. They all just got stopped out there because if you take a look at this, that's a 40 pip move. Most people don't have 40 pip stop losses, right? They're typically going, 10, 15, 20 pips at most. So you see a lot of that, right? So these guys got stopped out. They're taught that the more times the support and resistance is hit, the stronger it is. But from an institutional standpoint, you're taught that supply and demand zones, fresh, untested levels are stronger. The way I look at support and resistance levels, when you see this and it's being touched all this times, is that eventually it's going to break. It'd be like hitting glass, right? The more times you hit it, eventually it's going to break. And that's exactly what's happening here. So all these retail traders are taught that, the more times it's hit, the stronger it is. But guys, that's not necessarily true. As you can see, this support was touched many times. A lot of people could even say, hey, it's coming back again. And they could even put in some buy orders there. And then it went into some consolidation and then they would have got stopped out as well. So here we got another example. Price made its move up. You can define your support. You can define your resistance. Now, same thing. Buying at support, selling at resistance. They're just, moving through there. They got the breakout trade. They're thinking, all right, good to go. And stopped out. Again, same scenario, just a much larger move. Here you go. It went ahead, stopped out all the sellers. Push down, stopped out all the buyers. So we have identified that retail traders like to trade off of support and resistance, and they're always taught that the more times that support and resistance is touched, the stronger it is. And we just went through and showed you how that is not necessarily valid. Traders are taught to use supply and demand or institutional candles, order blocks. You'll hear it called a few different things. Now, when it comes down to it, it's always taught that fresh, untested levels are much better. Now, what I look for when I'm identifying my supply and demand is areas where price has aggressively moved away from an area. So you see up here, we had a massive bearish engulfing candle. And the way that I would identify this is I would come here and I would grab essentially the open of the candle up to the wick. Now that right there would be a nice supply zone, right? That's the way that the bank will go ahead and identify this. And you can see that we got a fresh untested level all the way up until this point here where it came up, tapped it, and then just completely melted. Now, when it comes down to it, they also identify levels of demand. So we see that price had come down here, worked all of its way down, and then just aggressively pushed away from this, right? So I would take that last bear candle here, grab the open of it, come down to the wick, and just like that, we have our demand zone. Now, another thing an institutional trader could point out is the fact that, when we're talking about how supply and demand levels that have been untested are much stronger, you can see we have a really good area of supply right here as well. A big old bullish engulfing candle. And you can see after we come up through this demand, once price came up and touched institutional candle, we had some resistance. And I mean, you guys can see from here, that was a 73 pip retracement once it touched that supply zone. So it had to come down and build up some pressure to be able to come up and grab this liquidity and mitigate this institutional candle as well. So another thing that smart money traders will use, imbalances. And essentially what that is like unfair price action, right? And you also hear it called like an IPA, right? Insufficient price action. You know, essentially what it is straight selling power. It was an unfair advantage to the buyers. Buyers didn't really have a chance to get in. It was just a massive move to the downside. And I'm drawing that from the bottom of this wick here to the top of this wick. We can see that some of it was mitigated before. So I could say now that the imbalance is here at just at the top of this institutional candle. So me as a smart money trader, I would see that what we're gonna have to do to get all of the liquidity here is push up, grab that liquidity, grab this imbalance, and then touch this institutional candle. And from here we can see the move was 334 pips just to come down and touch into this institutional candle here, into that demand zone. And then from there, bouncing off of that demand, you guys can see we had another 293 pip move. So, you know, the breakdown of retail traders versus institutional traders, you guys have to understand institutional traders make money by stopping out retail traders, right? And they're not just going off of support and resistance, they're going off of liquidity, you know, fair value gap, going towards where the money is essentially, right? So guys, that's a simple breakdown of that. I'll be doing a lot more education, breaking down institutional candles, breaking down imbalances, breaking down order blocks, how to trade them, how to refine your entries, going from higher time frame analysis to a smaller time frame analysis, and being able to break down the difference between macro and micro market structure. So we got a lot of stuff to come. Make sure you guys smash that subscribe button, hit a like on the video, guys. It definitely helps out the channel, and you know, drop in the comments if you learned anything new. Appreciate you guys' time. See you on this next video.